Good morning and welcome to this new webinar dedicated to metals. To talk about this asset class, I'm today with Marion Balestier, Commodity Fund Manager, and Benjamin Louvet, Head of Commodity at Tophi Invest Asset Management. Good morning.
Good morning, Nicolas.
So we had a webinar 6 months ago about the outlook of metals and with a very positive view on the long term. But unfortunately, this beginning of the year is not exactly as expected. Benjamin, please, could you share with us what is the current situation with metals?
Yeah, thank you, Nicolas. As you said, things didn't turn really well for the past few months. In fact, when you look at the performance of all metals, all are negative except gold. And you can even add to this list lithium or cobalt, who are down also for the past few months. We have today a conjunctural situation with a combination of cyclical factors that has put metals under pressure so far in 2023. The first thing, of course, is the monetary policies led by central banks around the world, and especially by the US Federal Reserve, which kept its hawkish tone for months now, pressuring growth expectation by saying that they will keep raising interest rates to tame inflation and to bring it back below 2%, which takes time clearly right now. Beside of this issue, this monetary issue, we also had a problem with China. Because China's reopening has been really slow to develop, and up to now the official support was really limited, as it looks like government in China decided to wait and see a little bit. But today there are reasons to be more optimistic about this aspect. Marion will explain further about that point later on. And also because the real estates and the property market in China is also still highly depressed. So all these things put together, knowing that China represents more, almost 50% of all the metals demand in the world, put a lot of pressure on metals. The reason why we were really optimistic a few months ago is because we thought that this recovery in China will be quite big and quite quick to happen. It takes time, so we have to deal with this for the moment, and to accept that we are today in kind of tomato syndrome. To be clear on this, what is the tomato syndrome? You have to understand that when you talk about assets, usually you used to talk about stocks or bonds that are based on companies, and the way you value companies is quite easy. You try to value future results at today's value, okay? So you look at the future results, the future return of the company, and you try to value it at today's value, which means that all of what will happen in the future is important to value the company right now. In the commodities market, it's something completely different. It's like when you go to the market on a Sunday morning and when you want to buy tomatoes. At that time, you really don't care about knowing if we will have some tomatoes in 6 months from now or no. What is really important is how much tomatoes you have on the market this morning. If you have a lot of tomatoes, you will have a low price for tomatoes. If you have only one guy who sells tomatoes, he can put the price he wants. So what I'm trying to say with this example, with the tomato syndrome, is that the price of commodities is a spot price. It's based on supply and demand balance right now at the moment where you trade on a commodity. And right now, it looks like there is less demand because of this worries about the global economy, and especially the worries about a slowdown in Western countries, in Europe and in the United States, because of rising interest rates. And so right now we are in a situation where, because of this, and also because in China you have this property market which is still in trouble, and the economy which takes time to recover, you see price as depressed for the time being. But that's only a conjunctural topic, and when you look at structural issues, they are still here and still here to stay. So we are quite optimistic and think we only delayed this kind of issues we got in the past few months.
In the table of performance you showed just before, there was a differences from one metal to another. And which metals were most affected by this syndrome?
The most affected metals are mainly nickel and PGMs. So PGMs are platinum group metals, so that means platinum and palladium mainly. Platinum group markets is mainly affected by three things. First, auto sector weakness. We thought that the car industry will restart quite heavily in the first months of this year, and it took time. Even if now we start seeing some improvement, especially in China, with a big recovery in last figures that we saw on the China's car market. The other point, this is important for platinum and palladium, because platinum and palladium are critical for the car industry. It is mainly used, platinum and palladium are mainly used to make catalytic converter for thermic engine vehicles. And so if the car industry is in a bad shape, the demand for these metals is going down. So that's the first point. The second point is that a lot of people are more and more inclined to think that the electrification of the car industry is on its way and will accelerate. We are agreeing with this, but I have to be honest with you. When you look at the demand that this transition will require in terms of metals, I am a little bit worried that it could be a constraint for the transition from thermic vehicle to electric vehicle. When you look at, for example, what the European Court of Auditor said a few days ago in a report, they say that we will lack of metals as soon as before 2030. Some of the metals that are critical for the electrification of vehicles, namely nickel, for example, or platinum or palladium or other metals like this. So that means that the price of these metals could go higher, and that could even make, the European Court of Auditors said, that could even make the electric vehicle unaffordable for a big chunk of the population. So probably, I think that people are too much optimistic right now about the transition from thermic engine vehicle to electric vehicle. We will have this electrification for sure, but it will take more time than what people think. First. Second thing, we will also probably have another consequence, which will be but we will probably have to switch first to plug-in hybrid vehicle. So having both a thermic engine vehicle and electric batteries, moving from one to the other. And you have to know that in this kind of vehicles, which we see are on the upside now in China, especially, where they were not almost nothing in the sales of cars in the past few months. Now you see a rising demand for this kind of vehicles, even in China. And these vehicles are still with a thermic engine, and so they need a catalytic converter. And what you have to know is that it could sound weird, but the catalytic converter of an hybrid vehicle is bigger than the catalytic converter of a pure thermic engine vehicle, because you have to switch from the electric engine to the thermic engine, and so the temperature of your engine, your thermic engine, is lower, and so the temperature of the fumes, and so you need more catalytic converting power to treat it. So we do think that this is a misunderstanding from the market right now, and probably the demand for palladium and platinum will go higher. by the way, you also have to know that norms for the car industry are tougher and tougher in thermic engine vehicles. And right now in China, they implemented the China 6 regulation, which is approximately the same as Euro 6A in Europe. And that led to a sharp rise in platinum consumption in the past few months. And now they will implement a new regulation, even tougher, called China 6B, if I'm right, Marion. And that will again lead to more platinum and palladium consumption in the catalytic converters for thermic engine vehicles. So all this was a burden for the price of platinum and palladium. Nickel was also hardly hit by the slowing recovery of the car industry, because it is highly used, more and more used in the electric vehicles, because it's one of the most important metals to make batteries, and so the demand for these metals went down. So all these worries pushed the price of all these metals lower, and there was also another point leading to the sharp drop we saw on the price, the palladium price, which is that it looks like there was some sales by the Russian government. You probably know that Russia is banned from selling gold abroad since the start of the war in Ukraine. And because of this, it looks like they decided to sell part of their palladium inventories. And rumors said that it could be between 60 and 120 tons that had been sold by the Russian government. When you know that the palladium market is 350 tons a year, that's really massive, and that can explain the kind of downside move we saw in the past few months. But the good news is that it looks like inventories now in Russia are really, really low, and so there will be no more sales coming from Russia. It looks like, because it's something secret in government inventories, but it looks like we are at the end of this kind of move. And so we are pretty more optimistic right now on these metals, and definitely we think that more than this, the market probably misunderstood what the energy transition in the electric mobility means, the time it will take, and so we think that the price of palladium should sharply rebound in the coming months. That's what I can say on these metals. You also have to notice something that could be of importance for platinum and palladium. These two metals are mainly produced by one country, South Africa. South Africa produces 80% of all the platinum production in the world and 40% of palladium production in the world. By the way, the other big producer of palladium in the world is Russia, where it can raise great questions about the ability of these metals coming on the market. Up to now, there was no problem in getting this metal on the market, but should the war keep going on in the coming months in Ukraine, maybe you can see some kind of restriction coming in, and so it could limit the capacity of Russia to sell some palladium on the market. But more than this, you have today a really difficult situation in South Africa. South Africa has a problem right now with its power production capacity. The local company that manages this production is called Eskom, and Eskom is in big trouble for years now. And the consequence of it is that last year we encountered 151 days of power outages at the national level, and the situation is worsening right now. And at the beginning of this year, on a 50 gigawatt power capacity as a total, 27 gigawatts were out of order, and this capacity will be out of order for at least months, even maybe years. So that has a consequence on the capacity to produce metals. And so since the start of this year, we said that in 2022 we got 151 days of load shedding. And this year, we already have 116 days on the first half of this year. So you can imagine the kind of impact it can have on the production. That's what led Anglo American Platinum, the biggest platinum producer in the world, to declare in its forecast at the beginning of this year that it will reduce its forecast in terms of production for platinum and palladium this year by 10% to the downside, but also for 2024 and also for 2025. So there will be a big supply constraint on these two metals. And this is what you can see on the graph on your right, where you can see that the balance between platinum and palladium market this year is forecasted to be in deficit on platinum and on palladium. And today, the price is down. Why? Because of the tomato syndrome. Right now, there is an imbalance and there is too much supply compared to the demand. But should the economy recovers in the coming months, we should see this imbalance taking place, and the price of metals will probably rebound sharply. So we are quite optimistic right now on this.
Talking about supply and demand, of course, China is probably the most important country for metals. Yeah. Marion, could you elaborate on this, please?
Right. Yeah, so part of the reasons for this cyclical weakness, as Benjamin has explained, is related to China and the fact that this reopening post-zero COVID policy experience hasn't produced much of a rebound in its traditional economy. It's very clear when you look at the left-hand chart here, when you look at the property market situation. What you can see is that the government has pushed for building completion, so ending the current constructions to restore a bit of confidence in the household sector. But the new starts for construction, the fresh activity on this market has stayed very subdued, as you can see on the dark blue bars still pointing to the downside. So the traditional economy side has stayed very weak and the support from the government has stayed limited so far. Wait and see mode, let's say, on the first half of this year. On the meantime, there is a completely different dynamic going on in some other sectors of this economy. When you look at these new sectors, meaning decarbonized transportation, electrified transport, renewable energies, and the grid deployment in China, investments, as you can see on the right side here, had been rising massively in the next few years, and especially in 2022 and in 2023. And as a result, these sectors have been booming recently very rapidly, even in this cyclical weakness situation. And as a result, China, since the start of this year, from January to May this year, has installed, it's still on the last slide, it still has been installing more renewable capacities in these 5 months of this 2023 than in the whole 2022, right? So massive acceleration of the energy transition in China. And China is leading the world, and I mean some other countries are doing efforts as well, to a massive acceleration of this transition. And so globally, across the world, we should be installing this year 340 gigawatts of solar and wind energy. This is the Bloomberg medium forecast for this year. It represents 100 gigawatts more than in 2022. So we are accelerating massively on this. So China is sending mixed signals, two-speed economies between the traditional and the new sectors. And this situation is clearly reflected on metals because all of these sectors are metals consumer, heavy metals consumers. And you can see on the left side here, the traditional sector. So this is we take the copper example here. The traditional sectors, the green bars have been consuming less copper than they used to, so copper demand has stayed very weak here. But copper demand from these new sectors related to the energy transition has been accelerating massively, and actually has accelerated so much that the net copper demand in China is actually up by 11% since the start of this year, right? So very strangely, this situation has stayed completely under the radar for now, and it has not been reflected in the prices for metals. Bunch of factors here. Of course, there is the fact that the sentiment is very negative right now. This China reopening trade has been completely reversed, and there has been recently a lot of defensive positioning construction to reflect the fact that China wasn't rebounding enough, and the fact that the global economy is also expected to slow down in the coming months. And so there have been a lot of short selling for copper and other metals. But there are also some physical reasons. And one of these reasons is the fact that in China, because of this low activity period, producers for metals have been able to rebuild part of these inventories for metals. And the Chinese industrials, since the start of this year, have been living mainly on these domestic inventories. So this rise in demand has stayed domestic, and the Chinese industrial haven't been going back to the international markets. And so this demand hasn't been impacting global prices as well. The interesting fact here, as you can see on the red line, so this is the inventory for this year, inventories right now are very low. So they have exhausted most of their domestic inventories. And so as a result, we should see Chinese buyers come back to the international markets pretty soon. And this should start impacting prices as well. It's interesting because we are still in a very weak cyclical situation, but the energy transition related demand has been more than compensating for this cyclical weakness. And so if we see a bit of cyclical recovery as well with these very low inventories and defensive positioning, we should see the situation improve by a lot for metals prices going forward.
Again, Nicolas, it's a perfect example of this tomato syndrome. You know, we have a lot of demand, but as right now there are some inventories, and Chinese people use these inventories, you still don't see any demand, and so you have an imbalance on the worldwide market for the time being. But as Marion just explained, now these inventories are at their lowest, and so probably we'll see this demand coming back on the market, and we will probably start seeing tensions in the coming months and weeks, and we should come back to more structural issues.
Exactly the question I wanted to ask to you. So, if I understood well, we are talking right now about a conjunctural situation, and if I remember well, in January you explained to us that the situation for metals is just amazing. And the outlook is incredible because mainly of the energy transition. Do you believe that the structural situation stays the same, or is it a little bit different right now?
In fact, we do think that the structural situation will take the driver's seat again in the coming months. It's just a delay in this global situation. When you look at the demand generated by the energy transition, we again had the publication of an IEA report regarding critical raw minerals just today. We also had this report coming from the European Court of Auditor, and a lot of information coming in are all pointing the same direction. We will lack of metals as soon as 2030 or even before for some of them. And so we will see the price of these metals probably under a really high level of tension, and probably the price going sharply higher. You can see here with this graph how things are going, and even worsening in some case. On the left side, you have a graph showing you the demand for platinum, and you can see that platinum is a metal that is more and more useful. I mean, that is critical for a new technology that is more and more developed, which is hydrogen. Hydrogen to store energy and hydrogen to produce electricity. And as we want to produce hydrogen on a cleaner way, today hydrogen is really dirty to produce, we need some electrolyzers, and to use this hydrogen we need fuel cells. And both electrolyzers and fuel cells are using a lot of platinum. So you should see in the coming months and the coming years, as you can see on this graph, the demand for hydrogen in the platinum sector going higher and higher and quite quickly. It could be, it could represent already something like between 20 and 25 tons of platinum demand as soon as in 2025, 2026, and could go up to probably something like 100 tons somewhere between 2030 and 2033. The global platinum market is a market of 250 tons. So you can see a really exponential demand grow for this industry in the platinum sector, and that will probably completely shift the balance on this market. By the way, this market, as we showed before, is weighted in deficit this year. So we are on something really important here on platinum. We had the same situation on silver in the past years. You know, in 2010 there was almost no solar industry and almost no electric vehicles sold at that time, and so the demand for silver coming from these two sectors was almost zero. Now, in 2022, the demand for silver coming from the solar industry and the car industry was almost 25% of the worldwide silver demand. So that means that this year, for the first time for more than 20 years, the silver market is weighted in deficit. Okay, it's just the beginning, and the growth was absolutely exponential in the past few years. You will probably see the same kind of thing on the platinum, and as you can see also on the right side of the slide regarding silver, it could even worsen in the coming years, because new technologies are sometimes giving you some advantages to reduce the quantity of metals you use, but sometimes you will need more from another metal. And in this case, in the new generation of solar panels, we need more silver than in the current solar panels technologies. As you can see on this graph, you will need between 30 and 100% more silver in the new solar panels technologies than in the current one. So we will definitely need a lot of metals. So that's the case for platinum, that's the case for silver, that's also the case for nickel, which is absolutely critical for the car industry. Copper is probably one of the craziest metal in terms of fundamentals, because you need copper everywhere. It's a Swiss knife of the energy transition. So in the forecast we saw, you have some forecasts giving you a deficit for copper going from 3 million tons to 8 million tons on a grossly 30 million tons market in 2030. So you will have a massive deficit in this market, which will probably lead to higher price, definitely, because you will have to incentivize producer to invest more in order to cope with this deficit, and we will have to see this happening quite quickly. Just to remind you, you can see the sentence at the top of this slide coming from the French Scientific National Research Center, which is really famous in France, saying that in the next 30 years, we will have to extract from the Earth's crust as much metals as since the start of humankind. So definitely the challenge is big, and today we are not in a position to fully answer to that challenge with all the investment we've done in the past. So we will have to accelerate if we want to be able to succeed in this energy transition and to succeed right on time. Probably metals could be a constraint, and the only way to get rid of this constraint will be to see the price of these metals going higher. So the structural situation is still the same or even worse for some metals, and so we are still quite optimistic and think that the situation we encountered since the start of this year is just a delay in our strategy, but we are still seeing a really powerful trend coming in this sector.
Thanks a lot. I think it was very clear and yes, very good. Thank you very much. And thank you to you to attending this webinar. If you have any question and if you want more information about our investment offer, don't hesitate to contact us. You have here all contact details and the contact details of our partners in Portugal, Italy, Spain, Austria, and Germany. Have a great summer and goodbye.